intangible. All right, so we know that we're going to have basically two categories of intangibles. Some that are separately transferable, that you could sell them like a franchise or something based on a contract. Others that cannot be sold separately, pretty much like Goodwill, that cannot be separated from the business as a whole. We normally would look at the Goodwill as outside of the indefinite life intangible assets. So there are some that could be separated and those that can't, but can still be recognized as intangible. So separately transferable intangibles, some could be based on legal rights, like the franchise, some are based on contracts, some might be a customer list. So for example, in a merger deal, you might pay, let's say there's a bank that buys a brokerage entity or a financial service company. They've got their list of clients. That customer list could have value. So that is something that, although it's not contractual, it is an intangible asset. Then you have others that are not separately transferable, and that's Goodwill. Goodwill is tied to the entity as a whole. It is the excess of the fair value, or the excess of the cost of what you paid for a business over the fair value of the net assets acquired. I'll show you some numbers in a second, but it's in a merger deal which would result in the following. So when you look at Goodwill, there's a couple of ways to calculate it. Now, net assets, of course, are assets less any liabilities. So, for example, in most mergers, you're going to acquire all, let's say it's 100%, you acquire 100% of the company's assets, but you accept their liabilities. So, for instance, if you're acquiring a manufacturing company, you acquire their plant assets, but you accept the mortgage as well. You accept responsibility for the mortgage on that factory. So those are the net assets you acquire. Those are appraised at fair value. Now, perfect example, we'll go back to the questions I guess we were talking about before about impairments, writing an asset down. We don't write assets up. Well, we write them up in this case. Why? Why would you be able to measure those assets and liabilities at fair value under this circumstance? You're buying another company. It's an objective transaction. I mean, the company you're buying, so this is the subsidiary company. That company can't sit around like tomorrow and say, you know what, on the US GAAP, my assets are worth $6 million more, I'm gonna put that on my balance sheet, I'm gonna write it up and take a gain. They wouldn't do that under US GAAP. But if somebody buys the company, those fair values are actually gonna be reflected in the merged entity, because you paid for it. I mean, you went out and you paid X number of dollars for this company, you paid fair value. Now the problem is when you pay more than fair value. The company's assets and liabilities are appraised at $700 million. You paid $100 million. 800 million, rather, 800 million. You paid 100 million more. So, in accounting, we rule out a mistake, a bad deal. Although the market does not really see it that way, they may think you overpaid. And it's sometimes the winner's curse if you're bidding. So, you want to buy a house, right? You go out into the marketplace, and the real estate agent wants a bid. For some reason, you really want this house. Maybe it's the location, maybe it's the amenities, and you start bidding up. You may actually pay more than the house is really worth. That's known as the winner's curse. When there is competition in a merger for another entity. That happens a lot. So the market looks at goodwill as, all right, you overpaid. Right? And that's what this is. Now, that's not always true. What else could goodwill be related to?
Donating money?
What's that?
Donating money, maybe?
No. Why would you pay more for another company than it's worth in terms of its appraisal?
I mean, like,
Anyway.
like, I guess, like, the client base that it has?
Yeah, so, well, the customer list would be recorded, but it could just be its reputation with its clients. So something you can't put on your books. So quality, reputation, location of the company, where it's located, the fact that you want to penetrate another market. It's also possible that you pay more for this company because of the perceived synergies. You know, if you look at lots of the mergers with, you start with, go back. I mean, it seems that, Jeeps are very popular, the product, the Jeep product. Where did it come from? It came from World War II. The Willys company, Willys, owned that. They sold it to American Motors, which used to be a U.S. company, and Chrysler bought them. In that merger, why did Chrysler buy Jeep? Four-wheel drive technology, right? So this is a way to get four-wheel drive vehicles without having to develop your own technology. So you could do it to buy technology, you could do it to get a competitive advantage, to penetrate a market, and that's what goodwill represents. It's an excess purchase cost over the fair value of the net assets that you acquire. Now, sometimes it's a mistake. Goodwill is in fact only recorded if it's purchased. There are lots of intangibles that we only record if we purchase them. So for example, and by the way, I know you mentioned customer base. Those assets are thrown into this pool, so new assets are created. So let's just say somebody buys Nike. Well, the logo, does anyone know what it's worth on the books of Nike right now? Nothing, because you're not allowed to value it. They pay $35 for it if you read the book. Some artist, a college student or a graduate student, developed a swoosh. They paid her $35, and that became the logo. That logo is valued at a zero amount on the balance sheet. Somebody buys Nike, what's going to happen? They're going to have to recognize the value of that asset. So new assets are created as part of the merger deal. Unrecorded assets have to be put on the books. So trademarks, trade names like Coca-Cola, the Apple logo, all of that in a merger deal has value to the company. Has value to the company. And even in cases where, do you notice that I guess a lot of companies do not eliminate the name of the predecessor company for a while. So you've got Duane Reade. Walgreens owns Duane Reade now, right? So you don't see Walgreens. I mean, maybe you see Walgreens and Duane Reade now. They're starting to put the names together. Sooner or later, I would think the Duane Reade name is going to go away, and I've seen that happen for years. I know you were in financial services. Morgan Stanley bought Dean Witter a long time ago.
Resell Fuller.
Yeah.
Where I was
There's legacy.
Exactly.
Yeah, there's legacy in there. So when I was working there, it was Morgan Stanley, then it was Morgan Stanley Dean Witter, and then the Dean Witter went away, and now it's just Morgan Stanley. They changed their logo, they changed their, so the name of the predecessor company kind of hangs around for a while. So maybe, the goodwill on the Duane Reade thing has got to be Walgreens is figuring, look, I don't know why, but there's like a Duane Reade on every corner in New York City, and they're still surviving, so there's got to be something to the Duane Reade name. So they might be paying for that name, and that could be part of the goodwill in that merger deal as well. Now, goodwill is an intangible asset that is not subject to amortization, because goodwill will last as long as the combined entity. So that goodwill will not go away. That goodwill is going to be, it could be impaired, but it's going to be on the books of the Walgreens Duane Reade combined entity for the life of that company. Now, one other question before we move on, and that is, what is this goodwill worth to, let's say, Rite Aid decides to buy the Walgreens, Duane Reade entity. How much are they willing to pay for that goodwill? Does anyone know? Nothing. It's worthless to anyone else except Walgreens. That was a personal, kind of a corporate payment. Just like you paid more for a house than it's worth because of something that was valuable to you, I'm going to buy the house from you and I'm not going to pay that premium, right? So goodwill is really worthless to the next buyer. And that's why on the balance sheet it's got a controversial flavor to it in lots of ways. All right, so, all right, let's repeat slide. I should have got rid of that. Okay. Now, remember that when you have these intangibles, you can only record the cost when they're purchased. Internally developed goodwill does not exist. Internally developed trademarks do not exist. You pay a little bit for a patent. All R&D is going to be expensed. We know there are problems in accounting for intangibles because we don't really know the benefits that we're getting. We're not sure, when you have a patent, what are the future benefits? Goodwill, same thing. We're not quite sure about those future benefits. So the useful life also is problematic. So I'm not going to go through this again. Just we'll pick up a couple of points now, but you don't have to memorize how long they last. I'm just telling you that if you buy a patent from another company, then it could be substantial. Patents, of course, would be amortized. You can't, if they're developed internally, all R&D is expensed, right? So if you're expensing all the research, Johnson & Johnson is expensing research constantly. When they finally get a patented product, the amount they capitalize is nominal, very small because it's only the registration fees. But when you buy it from another company, it could be substantial and it will be amortized. And the amortization period is going to be over the shorter of the legal life or the economic life. So if you got a patent that's going to last, for 28 years or something like that, but it's a patent for a microchip, that's probably going to only be economically valuable to you for about 3 years. So it's the shorter of the two. You amortize it over the shorter of the legal life or the economic life.
So the goodwill stays on the balance sheet, or is
Yes,
for the whole same amount for the whole entire time?
unless it's impaired.
Okay, so just an idea here. So what if there's inflation factored into it? Because if I pay $100 million today, it seems pretty bad. But if I pay $100 million in like 20 years from now, God knows be.
Yeah, it's true. It's going to be at historical cost.
Okay.
It's not going to change, but it could be impaired.
Okay.
So let's say that Walgreens thought that having all these Duane Reade stores synergistically would raise their revenues by 40%.
Right.
Doesn't happen.
Yeah.
Then the goodwill is impaired, and they have to write it down,
Right.
and they would take a loss. The impairment loss would look just like that. You would debit the loss of impairment and credit the goodwill. They look exactly the same. And that could happen with the possibilities that those just don't work. I mean, you look at goodwill with, a lot of the mergers with let's just say local radio stations. A lot of radio stations had formed consortium type groups where you've got, broadcasting from different parts of the country, but it's all one group, a network, and they were merging. A lot of that goodwill got written off because of all the electronic devices we have now, the ability to get music, satellite radio, all those intangibles, the broadcast licenses, as well as the goodwill got written down. Okay, and then, again, I'm not going to ask you to memorize these things, but there are certain points I do want to bring up. Copyright, okay, we know, creative plus 70 years, that changes all the time. And again, that's going to be capitalized and amortized over the economic life or legal life, whichever is shorter. The trademark, again, it's got to be purchased. Your trademark is not going to be, obviously, logo you're not going to be able to value that internally under US GAAP. Under IFRS, yes. Under IFRS, you can value lots of these things. For example, under IFRS, let's go back to research and development. Under IFRS, research is expensed, meaning when you start examining the possibility of developing a new product, that gets expensed. But once you hit the point where the scientists know that it's technologically feasible to develop the product, now you move into development, and development is an asset. So it's expensed up to a certain point, but then it becomes an asset. Under US GAAP, we expense everything. And the same thing's true with these trademarks. Developed internally, we expense them. And here's the Nike thing. I think, yeah, it was $35, right? And it was a graduate student. So don't do any work for anybody as a graduate student. But anyway, look, $35, you know, at the time might have been a lot. Now the franchise, these are expensive. I mean, these are going to go in your books with the startup cost and the franchise fees. And again, the franchise fee is about $30,000, but you have to have. I remember someone was asking me about this, not asking me to give them any money or anything, but they were asking me about a franchise, and apparently the upfront fee is $30,000 or $40,000 or whatever it is for McDonald's. But apparently they ask you, oh, somebody asked me about a Bear Burger. Never been there, but I heard that they're getting big. Want to open a Bear Burger franchise. Apparently they ask you to have, I think, $400,000 of reserve cash. Reserve cash, just cash hanging around, $400,000, right? So apparently these things are extremely expensive. So now what you would do here is that $30,000 would go on your books as the cost of that franchise, and that would be amortized, plus whatever else you put into that intangible asset. All right, now, we only amortize definite life intangible assets. So, franchise, a 10-year contract, the customer list we talked about, you think that's going to last, 15 years. You only write off definite or finite life intangible assets. Indefinite life intangibles like trademarks would not. Finite life intangibles are amortized on a straight line basis. They would be part of your selling general and administrative expense, and they are, as we said, tested for impairment. Now, when you buy a patent and you have $80,000, you have a legal life of 10 years, it's a contract, but the company believes that its benefits will only be 5 years. So you'll set it up on your books, and this is the way, I'm just going to show you this one thing and we are going to stop. You would debit the patent account and credit cash. You would set up an intangible as you would for any other long-term asset. Now, the amortization is the only thing you have to be careful about with problems. It's going to be the shorter of the two. So in this case, the contract tells you you have a franchise for 10 years, but the economic life for you is 5 years. So you believe you're only going to benefit from this for 5 years. Maybe you're going to develop the business and then sell it after, sell that franchise or have benefits from it for 5 years. So you would take a straight line. There is generally no residual on intangible assets, and we typically only use the straight line basis. And again, it's going to look exactly the same as depreciation. It's going to be a debit to the amortization expense and a credit to accumulate. And again, if it was impaired for any reason, we would impair it. If you have indefinite life intangibles or goodwill, they're recorded the same way. They're not amortized, but they're subject to impairment. All right, so a couple of things today. We're going to finish. I just got one or two things to say about goodwill. Then I want to try a couple of self-assessments. I just want to review the inventory and the depreciation. Forgot to hit the inventory earlier, so I want to get that done today. And then we're going to get into Chapter 9, predominantly focusing on the long-term debt. We're going to solve a lot of these problems. I've got present value tables if you want to use those. I posted those on Blackboard, I believe, and we'll use the calculator. I'm also going to, when we get back next week, don't forget we've got a Tuesday, Thursday next week. On Tuesday, we'll cover stockholders' equity, and I'll probably go over the operating cycle for Nike. If you go on Blackboard, you'll see the calculations to use the balance sheet, income statement, and some footnotes, I think, to calculate the operating cycle and to show you how some of these ratios work in. And on Thursday, we'll cover the cash flow statement. And then, of course, that's our last class, because the week after I'm at a conference, so that we'll talk to you about the final. Also mention some, maybe take-home components of that final or extra credit pieces of the final. I'll get that all out to you by Thursday. But for today, first, let's go to, just to finish 8. This will take like 5 minutes. Page or slide 80, we've got Goodwill. I just want to make sure we know what Goodwill is and how it's calculated, and talk about the Goodwill impairment. So, let's see. All right, so what Goodwill really, theoretically represents the idea that the company that you purchased in a merger has the ability to generate income over and above the industry average. Or it is something that is not specifically identifiable. It cannot be separately identified from the entity as a whole that you're buying. It might be a superior training, it might be a quality reputation, something that enables this company to generate a significant amount of income above the industry average. Or perhaps in a synergistic notion where the companies, once they emerge, will be able to create more profit than if they were separate. Now, mechanically, when we calculate it mechanically, it is the excess of the purchase price that you paid over the fair value of identifiable net assets of this company. So you have all of the assets appraised, you pay more for that, you can't identify it, you attribute it to Goodwill. So Goodwill from an accounting perspective is a residual. From an economic perspective, it's all of those other things I said before. But from an accounting perspective, it becomes a residual. So basically, if company A pays $200,000 to acquire all the shares of B, the net assets at book value, let's say, are $130, but don't forget the book value understates those assets because we don't use the fair value in US GAAP. So you go out, you get everything appraised, and you find out that the company's net assets are undervalued because land is undervalued by $45,000. So here's the way Goodwill would be calculated. You paid $200,000. That's the consideration transferred, and we have lots of mergers. I guess Yahoo is coming up, and we've got some others, acquisitions. So in this acquisition, somebody pays $200,000. The book value of the net assets, that's the historical cost of assets minus liabilities. Don't forget, we've said this before, and we'll see it today a little bit more, is that net assets are assets minus liabilities. So when we talk about net assets, assets minus liabilities, this is really the stockholders' equity of the company. So the net assets, the book value, the historical cost is $130. So now you paid $70,000 more than the book value of the net assets. Now, obviously, there's lots of reasons why you paid more. It could be unrecorded or undervalued assets. Now, out of that at $70,000, that $70,000 could consist, let's start with unrecorded assets. What are unrecorded assets? That could be on the subsidiary's books that we don't permit to be recognized unless you buy the company. We talked about other intangibles that do not get recognized unless they're purchased, such as a trademark. Right? Trademark, the logo, the company's logo, has no value until somebody buys it. So that could be added. That could be part of the $70,000 excess. Also, customer list. You buy a brokerage firm or you buy a commercial bank, there are subscribers. to certain services. You know, AT&T buys DirecTV. DirecTV had subscribers. Now, it doesn't mean that they're going to keep all of those subscribers, but that list has value to them. So customer lists, covenants not to compete, things like the logo, the company's logo, the trademark, that, or even research and development. How do we account for research and development in the United States? If you pay for it yourself, it is an expense. But if somebody buys your company, the research that's in progress has value. So that can also be part of the $70,000. So those are the unrecorded assets, in-process R&D, company trademarks, trade names, customer lists. Now, we don't have any of those. So the second reason, and let me put this here for you again. So you have the acquisition cost. So the excess cost over the book value is 7. So you can have unrecorded net assets. By the way, they could be unrecorded liabilities also. You know, net assets include liabilities as well. So in this case, because we do not have any unrecorded net assets, we have an undervalued net asset in this case, which is the land, $45,000, and therefore the residual is goodwill. Goodwill for publicly traded companies is not subject to amortization. It would sit on your books. So goodwill becomes a residual. It's an unidentified value. I mean, you may know what it is. It could be you're buying this company because you think by merging with this company you're going to get into other markets, or you're going to expand your business. I mean, you know, we're just thinking about, you know, company right up here, Audible. You know, they're probably thinking about acquisitions right now, how to use their technology. Or other companies you can think of would try to, you know, move into different areas to try to offset technological being outstripped by technology or technological obsolescence. So to get into these other markets, you might be willing to pay a premium. And by the way, this could actually be also a control premium. Because if I'm just buying the stock of the subsidiary company, I'm paying market price. But once I go out there and start to try to buy all of those shares, it drives up the market price. So to get control, I may have to pay a premium. Or if you and I are both bidding for the same company, like, you know, two people bidding on the same house, you might go up a notch, and that premium is a control. You want control, you want to buy that property, that's a control premium. So this could actually be a control premium, and it's only valuable to the person buying that company. Now, we also define goodwill as the excess cost over the fair value of the company. The subsidiary's fair value is how much? It's the book value plus the revaluation. So the fair value of the subsidiary is 130 plus the 45. So the fair value of the sub is really 175. So you paid $200,000 for a company that is valued at 175. That's its appraisal, and the residual is called goodwill. So goodwill for publicly traded companies is not amortized. It is subject to impairment. It could be written down if it's found to be of lesser value. Goodwill is amortized. You know, you might have, in fact, when PwC was here, I think everyone was at that presentation. Amanda DiBartolo was representing PwC. She was in what was called private client services. Those companies are not publicly traded, and those companies can amortize goodwill. So there's something known as big gap, little gap, as we'll see next semester. Smaller companies have different sets of rules. There is something known as the Private Company Council, which promulgates accounting standards for smaller companies. So you may be working in a private client service, whether it's at Cohen-Resnick or Amper, Eisner-Amper, or wherever the firm is. You may be working with privately held companies, and those companies do not necessarily follow the same gap as a publicly traded company. So publicly traded companies do not amortize goodwill, smaller companies will. And goodwill is tax deductible. Goodwill is tax deductible. And the reason why goodwill is tax deductible is because it wasn't for a long time, but we found that we had problems in cross-border mergers. Other countries are able to, deduct goodwill on their taxes. It made the deal cheaper for them than for a U.S. company. So in order to make the U.S. as competitive, goodwill is now tax deductible as well. But it's not deductible for publicly traded companies on their books. All right, here's the last point. Goodwill impairment. So let's say a year from now, you find out that company B, you do another appraisal. And by the way, the goodwill impairment testing, which we'll do next semester, involves several steps. The first thing you do is, in order to minimize goodwill testing for impairment, and why? It's expensive, because you have to revalue an entire company, which isn't cheap. Just to get an appraisal for your house is going to cost you money. Could you imagine revaluing an entire entity? So the goodwill impairment test is first subject to some qualitative decisions and impairment indicators. But if you find out that goodwill may be impaired, you would have to go out and get a fair value appraisal. So somebody appraises the company now at 160, but it was on your books at 175, and you have to write it down. So you assume that the differential, and this is an oversimplified example, but you would impair the goodwill. You would debit a loss on your income statement, and you would credit the goodwill. So goodwill could be impaired. Okay,